Hello and welcome to Global Finance Watch. Today we are deep diving into the latest decision by the Bank of Russia and its ripple effects on the ruble. Particularly, the CBR has just announced a sharp cut in foreign currency sales for the year 2026. This is a critical move in Russia's monetary policy.
According to Reuters, this decision marks a significant shift. In today's scenario, we will analyze the current economic context.
We'll cover 5 key areas: the current economic backdrop, why the CBR is reducing sales, the impact on the ruble.
Let's begin with the context. By the end of 2025, the Russian economy is officially in a cooling phase, driven by strict inflation targets.
GDP growth has slowed drastically. From a robust 4.3% in 2024, it is projected to hit just 1% this year.
This isn't an accident. Authorities have stated this slowdown is a result of conscious actions by the central bank to finally cool down the overheating market.
The goal? Lowering inflation. We are seeing forecasts drop from 9.5% previously down to a target.
Independent polls by Reuters in December confirmed these figures. The economy is stabilizing, albeit at a much slower pace than before.
To achieve this stability, the central bank pursued an incredibly tight monetary policy throughout early 2025.
We saw rates skyrocket past 20% to curb volatility, before gradually easing down to 16% by this December.
This aggressive strategy worked. Inflation fell significantly from a high of 10.3% in March down to 6.9% by November.
Crucially, strict capital controls and the freeze on central bank foreign accounts, in place since 2022, remained firmly in effect.
The result? A surprisingly resilient ruble in 2025, surging over 45% against the US dollar at its peak.
However, a skyrocketing currency is a double-edged sword. This rally has been squeezing the very lifeline of Russia's economy, the exporters.
As the ruble strengthens, energy and mineral companies receive less domestic currency for every dollar earned abroad. The complaints are getting louder. Recognizing this, the government had to adjust its reality. The 2026 average. Add to this the risk of declining oil and gas revenues. Prices are projected to hit their lowest levels since 2020.
Interestingly, the government stopped dipping into the National Wealth Fund late last year to plug holes, opting for domestic borrowing instead.
Despite energy prices hovering near their lowest levels since 2020, the budget remains in a moderate surplus, showing fiscal resilience.
So here is the snapshot of late 2025. Minimal growth, cooling inflation, interest rates that are high but falling.
This brings us to the million-dollar question. If the ruble is strong and inflation is down, why is the central bank suddenly pulling back its support?
First, we must admit that the state itself, the Ministry of Finance and the central bank, has been the biggest whale in the market.
Their consistent selling of foreign currency was the primary engine driving the ruble's 45% rally. But this artifact exporters are hurting. They sell oil and metals for dollars, but with a super strong ruble, they get far less local currency to pay their workers and taxes.
It's a mathematical squeeze. The liquidity was too abundant, and the exchange rate too punitive for the export sector. Sofia Donets from T-Bank notes that this cut, combined with lower export prices, is a deliberate recipe for a softer currency.
There is also a fiscal reason. The government is no longer frantically selling foreign reserves to plug budget holes.
In the second half of 2025, usage of the National Wealth Fund dropped to near zero as they switched to domestic borrowing.
So, the state steps back. What happens when you remove the biggest seller from the market?
Basic economics. Supply drops, demand stays constant. The price of the dollar should rise. The ruble should fall.
Surprisingly, the immediate reaction was muted. The ruble actually gained slightly to 77.7 per dollar. The market had already priced this in.
But don't let the calm fool you. The medium-term consensus is clear. Gravity is coming for the ruble.
A recent Reuters poll predicts the currency will weaken significantly, heading towards 95.75 rubles per dollar by the end of 2026.
A weaker ruble comes with a price tag. It means imported goods, electronics, machinery, parts will cost more, potentially reigniting inflation.
This pass-through effect forces the central bank to stay vigilant. They can't let the currency slide too far, too fast.
But for the exporters, this is the relief they've been waiting for. Selling foreign currency at a higher ruble rate boosts their bottom line.
It improves their ruble-denominated revenue, helping them cover domestic costs and investment despite lower global energy prices. For investors, this shift introduces volatility. We may see a flight to safety assets like gold as the market.
This move is part of a larger playbook. Let's look at Russia's monetary strategy for 2024 through 2026.
The North Star remains unchanged, a long-term inflation target of 4%.
The central bank operates under an inflation targeting regime. They adjust interest rates specifically to guide price growth back to this 4% anchor.
Since 2014, the ruble has been free-floating. This float has been continued.
We've seen rates hit emergency levels of over 20% to stabilize the economy during shocks, creating a high-interest environment for years.
But as the economy cooled in late 2025, the strategy began to pivot. The era of ultra-tight policy is slowly ending.
We saw the first signs in September, with a rate cut from 18% down to 17%.
And the path is set. Reuters surveys predict the key rate will fall further, reaching 13% by the end of 2026.
Governor Nabulina's ultimate goal? To bring inflation back to 4% and return rates to a neutral range of 7.5 to 8.5%.
But timing is everything. Cut rates too early while the economy is still hot, and inflation could explode again.
To navigate this, the central bank uses a flexible toolkit: interest rates, reserve requirements, and crucially, currency intervention.
The reduction in FX sales is simply one of these levers. It signals a shift from forced stability to market reality.
Instead of constantly propping up the ruble, the central bank is allowing the currency to find its natural level.
However, they are watching the budget closely. If the deficit widens, they may have to tighten the screws again.
In essence, the 2024-2026 strategy is a balancing act, protecting the ruble's value while gradually taking the...
We are witnessing a shift from a very strong ruble policy back to a market-determined rate.
So, what does 2026 hold for the Russian currency? The consensus is clear. The peak is behind us.
Reuters analysts forecast the exchange rate will slide to approximately 95.75 rubles per dollar by the end of 2026.
That is a significant depreciation from the current level of around 77 rubles.
Even the government's own adjusted forecast of 92.2 rubles aligns with this trend. The days of the sub-80 ruble are likely numbered.
However, historically speaking, this is a controlled slide. We are not seeing the panic predictions of 100 plus that we saw in previous years.
Why? Structural changes. Import demand remains low, capital is trapped domestically, and trade in rubles has surged.
In fact, the share of Russian exports paid for in rubles has skyrocketed from just 14% to over 57%.
Ultimately, the 2026 outlook rests on three pillars: global oil prices, domestic growth, and the central bank's steady hand.
Scenario A. If oil prices remain stable or rise, the balance of payments stays healthy, acting as a natural floor for the ruble. Scenario B. If a global supply glut crashes prices, the pressure on the currency will intensify, potentially pushing it past the 100 mark.
However, the domestic economy offers a shield. With slow growth, demand for imports is weak, which naturally limits the selling of rubles.
The real wild card? The speed of the central bank's pivot.
If they cut interest rates too aggressively, capital could flee, weakening the ruble faster than anticipated.
But if Governor Nabulina maintains a cautious, higher-for-longer approach, the currency will stabilize in a manageable range.
Putting it all together, the consensus lands here. A range of 90 to 100 rubles per dollar by the end of 2026.
This isn't a collapse, it's a recalibration. This range restores competitiveness to Russian exports without crushing the consumer.
But staying in this Goldilocks zone requires constant vigilance from the Ministry of Finance and the central bank. So, to wrap up our analysis of this pivotal decision, let's summarize the key takeaways.
First, the context. Russia's economy is cooling down by design, with inflation finally dropping towards the target.
Second, the action. The central bank is slashing foreign currency sales to stop artificially propping up the ruble. Third, the impact. This will weaken the currency towards the 90-100 range, boosting export revenues but raising import costs. Fourth, the strategy. It's a calculated move away from emergency controls back to market mechanisms. And finally, the outlook. A controlled, gradual depreciation that supports the budget without crashing the economy.
What we are seeing is a maturing of policy. The super ruble era is over, replaced by a currency that reflects the true state of trade.
It is a transition from fighting the current to steering the ship. Risky? Yes, but necessary for the long haul.
But what do you think? Will the ruble hold at 95, or will external shocks push it further? Let us know in the comments below.
I'm Alex Sterling. This has been your Global Finance Watch update. Thanks for watching and see you next time.